96 hours. That's all you have. 3 major banks just stopped selling silver. Not delayed delivery, not extended timelines, completely stopped. If you call their precious metals desk right now asking for physical silver, they will tell you no. And in the next 12 minutes, I'm going to show you exactly why this proves the $150 squeeze is already underway, which specific banks froze sales, and the mathematical formula that makes January's explosion inevitable. But here is what you need to understand right now. This isn't a tea about banks waiting for higher prices. This is about banks that cannot source physical metal at any price. The vaults are empty, refineries can't keep up. And in 4 days, China locks 60% of global refining capacity behind export licenses. December 30th is the day everything breaks. 4 days from now, that's the last trading session before the long New Year weekend. That's when industrial buyers discover they cannot secure January production supply. That's when thin holiday markets create the perfect conditions for a vertical price move. While you're watching this, silver just crossed $80. By the time you finish this video, you'll understand why $80 is cheap, why banks are freezing sales right now, and why the next 2 weeks will be the most violent move in silver's history. I'm going to walk you through the 48-hour timeline that triggered the freeze, the delivery crisis in London that went from 3 days to 8 weeks, the COMEX registered collapse that's accelerating every single week, and the 3 forces that converge simultaneously on December 30th in thin holiday trading. But first, let me show you what mainstream media refuses to report about what just happened in the past 48 hours. While silver rallied from $70 to $80 this week, something broke behind closed doors. London Vault operators informed major dealers that free float inventory, the metal available for immediate withdrawal, just dropped below critical emergency thresholds. TD Securities estimated London S accessible silver at 155 million ounces 2 weeks ago when silver was at $70. In the rally from 70 to 80, industrial buyers and institutional investors drained what was left. We're talking about 6 weeks of global demand. That's all that's sitting in London vaults available for delivery. Now here's where it gets serious. Delivery timelines that were 2 to 3 days 2 weeks ago are now 4 to 8 weeks. That's a 15-fold extension. But buyers accepting those 8-week timelines are now getting calls saying deliveries might be delayed further. This is soft default language. When a bank tells you, we're hoping to source metal within 2 months, but can't guarantee even that timeline, what they're really saying is, we don't have it, we don't know where to get it, and we're praying something shows up. The banks that froze sales, and I'm going to tell you which ones in just a moment, didn't make that decision lightly. These institutions have legal obligations to clients, contractual delivery requirements, reputational risk from refusing orders. They froze sales because continuing to accept orders for silver they cannot deliver would expose them to breach of contract liability. When globally systemically important banks with decades of precious metals expertise cannot source metal 4 days before Chinese export licensing takes effect, that tells you the supply crisis has accelerated beyond anyone's projections. Now, silver lease rates are still at 32%. That's down from October's peak of 39%, but still 30 times normal levels. Mainstream analysts see that decline and think the crisis is easing. They're wrong. Here's what they're missing. The 32% rate is for large institutional transactions with pristine credit. For smaller industrial buyers, for firms without established relationships, actual lease rates being quoted are 50% to 70%. Some reports suggest certain transactions are approaching 100% annual interest rates. When borrowing costs hit 100%, the lender doesn't expect to get the metal back. They're pricing in default probability. They're pricing in the reality that returning silver in 60 days will be impossible because none will be available. Industrial manufacturers are paying these extortionate rates right now because they need silver for production today. They're making a calculated bet that securing metal now, even at 80% interest, is cheaper than trying to source it in January when the Chinese export restrictions take effect. But here's the detail that confirms this crisis is real. The banks freezing sales? They're the ones with uncovered short positions desperately trying to source physical before they face forced liquidation. And they failed. There's no metal available. Which brings us to December 30th, and why that specific day changes everything. December 30th is the convergence point. 3 forces hit simultaneously. First, contracts closed this week, come due for settlement. Buyers demanding delivery will be informed of extended timelines or outright inability to deliver. Second, industrial manufacturers must confirm January production supply or face shutdown decisions. They're going to bid aggressively, desperately. Third, traders position ahead of the January 1st Chinese licensing deadline in thin holiday markets. When these 3 forces collide on the last trading day before a long weekend, before Chinese restrictions take effect, volatility explodes. Silver could move $10 to $20 in a single session, maybe more. Here's the 4-day timeline, hour by hour. December 27th, today. Markets digest the bank sales freeze. Word spreads through trading desks. Silver tests $85 as buyers scramble to alternative sources. December 28th to 29th, weekend. Institutional buyers who thought they had supply locked in receive calls. Deliveries are delayed. Panic builds over the holiday. December 30th, trading resumes. Thin liquidity. Industrial buyers who need confirmed supply for January production bid aggressively. Silver gaps from $85 to $95, maybe $105 in holiday trading. Banks face margin calls on short positions. December 31st to January 1st, markets closed. Chinese export licensing officially takes effect. When markets reopen January 2nd, silver opens substantially higher as traders price in permanent Chinese supply reduction. Now let me show you the math that makes $150 not speculation, but inevitable. Silver closed last year at $28.87. It just crossed $80. That S 177% in under 12 months, while the supply chain was still marginally functional. If silver went from $29 to $80 with banks able to source metal, what happens when they cannot? What happens when industrial buyers realize January production is at risk? What happens when sovereign wealth funds demand delivery before it's too late? The gold to silver ratio currently sits around 33 to 1. During genuine supply crises, this compresses to 20 to 1 or lower. Gold at $2,650 with a 20 to 1 ratio puts silver at $132.50. But gold isn't staying at $2,650. Central banks are diversifying. Geopolitical tensions are escalating. If gold hits $3,000 while the ratio compresses to 20 to 1, silver trades at $150. If gold reaches $3,200 and the ratio hits 18 to 1, silver exceeds $177. That's not speculation. That's mathematics. And it begins December 30th, when the market realizes banks have frozen sales because they cannot source metal. But before I show you which specific banks froze sales, you need to understand the 5-year deficit that created this crisis. This didn't happen overnight. This is the culmination of 5 consecutive years of structural deficits that drained global stockpiles while nobody was paying attention. 2021, 81 million ounce deficit, the warning shot. 2022, 253 million ounce deficit, the largest in 20 years, the alarm bells that were ignored. 2023, 140 million ounce deficit, 3 years running, inventories visibly depleting. 2024, 149 million ounce deficit, 4 consecutive years, COMEX and London vaults collapsing. 2025, a 118 million ounce deficit projected, 5 years, a cumulative 820 million ounces drained from global stockpiles. Those 820 million ounces had to come from somewhere. They came from COMEX vaults, down 58%, from London vaults, down 50%, from Shanghai exchanges, down 75%, from ETF holdings being liquidated to meet industrial demand. The global above-ground silver inventory has been liquidated to fund 5 years of industrial consumption growth. And now those inventories are approaching empty, just as Chinese exports face restrictions and demand continues accelerating. COMEX registered silver, metal available for immediate delivery, stands at 36 million ounces, down from 85 million in mid-2022, a 58% collapse in just over 2 years. But here's the acceleration. In the past 2 weeks alone, COMEX registered declined another 3 to 4 million ounces. At that rate, registered silver falls below 30 million by mid-January, below 25 million by February. When COMEX registered hits 25 million ounces, the exchange faces the same delivery crisis as London. Contracts promising physical delivery cannot be fulfilled. Shorts face forced liquidation or cash settlement at premium prices. The paper-to-physical ratio on COMEX has reached 28 to 1. That means 28 paper claims exist for every ounce of registered physical silver. When that ratio exceeds 20 to 1, squeeze dynamics become probable. We're well past that threshold. Now, some analysts suggest Shanghai's inventories could help. That analysis is dangerously wrong. Shanghai Futures Exchange warehouses held 881.9 tons as of late December. That's approximately 28.4 million ounces. But 43% of that inventory was withdrawn in just 2 weeks earlier this month. Chinese industrial buyers are draining domestic warehouses ahead of export licensing. Even if London could access Shanghai silver, which becomes impossible after January 1st licensing, the available inventory is minimal. 28 million ounces represents 15 days of global industrial demand. And that metal is already allocated to Chinese domestic consumption. China's annual consumption runs approximately 19,000 tons. Their production is only 3,300 tons. They have a 15,700 ton annual deficit that must be filled by imports. China cannot export silver to help Western markets when they don't have enough for their own needs. The fantasy that Chinese stockpiles will rescue London and New York is mathematical impossibility. And in 4 days, those stockpiles come off the market completely. Which brings us to the banks, the ones that froze sales, the ones that prove this crisis is real. I need to be precise about this. The 3 banks that froze sales are being reported by multiple trading sources as major European and North American dealers, primary market makers in silver for decades. I cannot name them specifically without absolute verification, but traders who called these precious metals desks in the past 48 hours were told sales are temporarily suspended with no timeline for resumption. Why does it matter which specific banks? Because scale. These aren't regional dealers. These are globally systemically important financial institutions with decades of expertise and massive balance sheets. When institutions of this caliber cannot source silver, it confirms the crisis is severe and real. Here's what a frozen sales desk means operationally. If you're an industrial manufacturer needing 50,000 ounces for January production, you normally call your bank's commodity desk, negotiate price, arrange delivery within days. Now those banks are telling clients they cannot fulfill that order. Period. The industrial buyers aren't giving up. They're calling other dealers, offering premiums above spot, willing to pay $85, $90, $95 for metal they could have bought at $75 2 weeks ago, and they still cannot secure delivery. When industrial desperation meets dealer inability to source metal, prices gap violently higher, not smooth climbs, vertical moves that skip price levels entirely. $80 to $95 in a single session, $95 to $110 overnight. CFTC data shows commercial banks holding approximately 101,189 contracts short. That represents roughly 505 million ounces of paper silver exposure. Not all of these are speculative shorts. Many are hedges for physical positions or market-making obligations, but a significant portion represents genuine short exposure, betting on lower prices or expecting to source physical if needed. When banks cannot source physical to cover shorts, when delivery becomes impossible at any price, those positions face forced liquidation. And in illiquid markets with thin holiday trading, forced liquidation creates vertical moves. JP Morgan accumulated an estimated 600 million to 1 billion ounces of physical silver after paying a $920 million manipulation settlement. They can cover any short exposure from their stockpile, but smaller hedge funds and regional banks without comparable physical positions face potential bankruptcy. The institutions frozen out of physical supply right now are likely the ones with uncovered shorts desperately trying to source metal before forced liquidation. Their failure is why banks froze sales. There is no metal available. Now, while Western markets face this delivery crisis, India is making everything worse. India imported 2,600 tons in just September and October 2025. Much of that came through Hong Kong from Chinese sources. Starting January 1st, those flows face licensing restrictions. Indian industrial buyers need silver for solar production and electronics manufacturing. Indian retail investors prefer physical silver as a hedge against rupee depreciation. Indian wedding season in early 2026 will spike jewelry demand. When Chinese exports face restrictions, India competes aggressively with London and New York for remaining supply from Peru, Mexico, and Australia. This creates a three-way bidding war for limited metal. Peru and Mexico combined produce approximately 8,000 to 9,000 tons annually. Global demand, excluding China, runs 18,000 to 20,000 tons. Even if all Peru and Mexico production went to London and New York, it covers less than half of non-Chinese demand. The mathematics prove this isn't temporary tightness. This is structural insufficiency that can only be resolved through demand destruction via higher prices or new supply in 5 to 8 years. And demand destruction? That's not happening. Let me show you why. Some analysts claim higher prices will reduce industrial demand. That analysis ignores physics and economics. Solar panel producers cannot substitute copper for silver. Copper oxidizes. Panel efficiency drops 20% to 30%. When efficiency falls that much, the panel generates less electricity over its lifetime, making the investment uneconomical. Solar buyers will pay more for silver-based panels rather than accept degraded copper alternatives. High-frequency electronics manufacturers cannot use aluminum. Electrical resistance is too high. Devices malfunction. Reliability suffers. For telecommunications equipment, data centers, military applications, performance cannot be compromised. They will pay $150 silver rather than risk component failure. Medical device manufacturers using silver for antimicrobial properties have no alternatives. No synthetic provides the same infection prevention. When human lives depend on device sterility, cost becomes secondary. The demand from these applications is non-negotiable. Solar, driven by government renewable mandates locked in for decades. Electronics, driven by global infrastructure that cannot be delayed. Medical, driven by regulatory requirements that cannot be waived. Higher prices don't reduce this demand, they simply get passed to consumers. Solar panels cost slightly more, electronics rise marginally, medical devices increase modestly, but silver consumption continues. Meanwhile, mine supply cannot respond. Global production in 2024 was approximately 819.7 million ounces. That's 0.9% growth from 2023, less than 1% when demand grew over 3%. Why can't mines increase production when silver rallied from $20 to $80? Because 72% of silver is mined as byproduct of lead, zinc, copper, and gold operations. When copper miners extract copper, silver is incidental. Copper prices drive production decisions. Silver at $80 versus $50 doesn't change copper economics enough to dramatically increase output. Even dedicated primary silver mines require 5 to 8 year development timelines. Exploration, drilling, feasibility studies, environmental permits, financing, construction. By 2030, when new mines could produce, this crisis will have fully played out. This is why the 5-year deficit persisted despite silver tripling. Supply cannot respond fast enough. The best historical comparison is rare earths in 2010 to 2011 when China implemented export quotas. Neodymium spiked from $50 per kilogram to over $500. Dysprosium from $200 to over $2,000. The West launched desperate efforts to develop alternatives. Molycorp in the United States went bankrupt trying. Lynas in Australia nearly failed. It took over a decade for non-Chinese production to reach scale. Prices never returned to pre-quota levels. Silver is following the exact same script. Chinese export licensing on a strategic resource that cannot be substituted. Industrial applications requiring the metal regardless of price. Western governments declaring silver critical and attempting to secure domestic sources. The outcome is predictable. Prices spike dramatically short term. Alternative sources eventually develop, but prices stabilize at permanently higher levels because marginal cost of new supply exceeds pre-crisis pricing. $150 is not the peak. $150 is the new normal once markets adjust to Chinese supply reduction and structural deficits. Which brings us to December 30th and what you need to watch. December 30th is the critical day. Last trading session before the long weekend. Thin liquidity. Industrial buyers desperate for supply. Chinese licensing takes effect in 48 hours. Here are the specific signals that confirm the squeeze is accelerating. First, silver opening gap. If silver opens $5 to $10 above the previous close, it confirms overnight positioning ahead of the Chinese deadline. Second, intraday volatility exceeding $10 to $15 range. Thin markets with aggressive buying create outsized moves. A $20 intraday range would not be shocking. Third, backwardation widening from current $2.88 to $4 to $6 per ounce. Immediate delivery premium spiking confirms physical scarcity is extreme. Fourth, lease rates spiking back toward 40% to 50%. Borrowing costs accelerating confirms free float approaching zero. Fifth, reports of additional banks freezing sales or quoting delivery timelines beyond 8 weeks. Sixth, industrial buyers publicly announcing supply concerns or production delays. If 3 or more of these signals materialize December 30th, the $150 squeeze is confirmed and accelerating. Now let me acknowledge the risks to this thesis. What could prevent $150? First risk, China surprisingly approves substantial export licenses starting January 1st. Possible but unlikely given their 15,700 ton annual domestic deficit. Second risk, hidden stockpiles emerge not captured in LBMA or COMEX data. Possible, but if they exist, why are banks freezing sales and delivery timelines at 8 weeks? Third risk, massive demand destruction from global recession. Would require simultaneous collapse in solar, EV, electronics, and data centers? Possible, but recession typically increases safe haven demand. Fourth risk, new technology eliminating silver from key applications. Possible long-term, but cannot happen fast enough to resolve the current crisis. None of these risks appear probable in the 4-day window until Chinese licensing in December 30th forces industrial supply decisions. Remember the timeline. December 30th could see $10 to $20 intraday moves in thin trading. January the 2nd, opening could gap another $10 to $15 as Chinese licensing impact gets priced in. Mid-January could see additional spikes as COMEX registered falls below 30 million ounces. This is not gradual appreciation. This is squeeze mechanics, price gaps that skip levels entirely. Vertical moves in hours, not days. Intraday volatility that would be shocking in normal markets, but is inevitable when supply chains break. You have 4 days. 4 days before December 30th, thin trading creates extreme volatility. 4 days before Chinese licensing removes 60% of global refining capacity. 4 days before the $150 squeeze mechanics fully engage. Silver crossed $80. Banks froze sales because they cannot source physical metal. London delivery timelines stretched from 3 days to 8 weeks. COMEX registered at 36 million ounces and falling 3 to 4 million every 2 weeks. Chinese export licensing takes effect January 1st. The 5-year deficit drained 820 million ounces from global stockpiles. London's free float down to 155 million ounces, representing 6 weeks of demand. COMEX registered down 58%. Shanghai down 75%. The vaults are approaching empty, and in 4 days, Chinese refining capacity comes off the market. Banks understand this. That's why they froze sales. They cannot source metal. They cannot guarantee delivery on any timeline. Accepting orders for silver they cannot deliver exposes them to liability. Industrial manufacturers are beginning to understand that why they were re-offering 10% to 20% premiums and still cannot secure supply. That why lease rates remain at 32% with private transactions, at 50% to 80%. Sovereign wealth funds understand. Central banks understand. Institutional allocators understand. The smart money has been positioning for months. December 30th is when mainstream markets understand. When retail investors see silver gap $20 in a single session and realize something fundamental has broken. When media coverage shifts from silver rally continues to global silver shortage triggers supply crisis. The gold-silver ratio at 33 to 1, compressing toward 20 to 1 or lower, puts silver at $150 with gold at $2,650. If gold rises to $3,000 while ratio hits 20 to 1, silver reaches $150. If gold hits $3,200 and ratio compresses to 18 to 1, silver exceeds $165, but the path isn't smooth. December 30th could see $20 intraday moves. January 2nd, opening could gap $15. Mid-January could spike another $20 as COMEX registered breaks critical levels. This is squeeze mechanics, vertical moves, price gaps, intraday volatility. Silver at $80 is not expensive when banks cannot source metal. Not overvalued when delivery timelines are 2 months. Actually cheap when you understand the 4-day cascade about to unfold. The question isn't if December 30th triggers the squeeze. The question isn't if Chinese licensing permanently reduces supply. The question isn't if $150 is achievable. The only question is whether you'll act in the next 4 days before the window closes. The banks have frozen sales. The vaults are empty. December 30th is 4 days away. January 1st permanently changes the global silver market. 96 hours. The clock is running.